So GDP pulls back a little bit of a hair, or which is first quarter GDP, which is a little bit scary.
Oh.
And what that it's interesting with the first quarter GDP falling 1%. We could have, if we lost one other point, we would be officially in a recession. Here to talk about that, Brent Wilsey, Wilsey Asset Management. Brent, I'll tell you. Now we all know why this happened.
Right.
But the news certainly sounds scary, doesn't it?
It does, and that's why you can't just read the headlines, because that's what people do. They read the headlines, they go, "Oh my gosh, things are terrible." Oh,
hey, quit talking about me. I'm still in the room.
Yeah, right.
Yeah,
that's
what I do.
By the way, I like the hair. New hairstyle?
Very much. I don't know what it is.
I just noticed that. I'm sorry.
Yeah, thank you.
Well,
You
but
too.
listen to this. So when you hear first quarter GDP and you think, oh my gosh, we contracted. And of course, the stock market was horrible that first quarter. I think, boy, we just finally got out of this recession. It seems like things are going well. What happened? Well, what happened was the weather.
The weather. And let's kind of think about that, because, the weather, can't blame the weather. You can't blame the weather. There wasn't just like a slowdown. There were stores that were closed.
Yeah.
People were not going out. Think about, and inventories were down, exports were down. Why? You couldn't drive trucks on the freeway to get to places. Actually, back east, I think they call them highways.
That's right.
But you couldn't transport stuff, so that hurts the economy.
Right.
And that's why we had this GDP of a negative point, or at 1% negative.
Yeah, 1% negative. That's a big, but that's a volatility marker too.
Right.
And I think though, I believe that most people have taken that into consideration. I mean, there was a little bit of panic this morning when the news first came out, but I think people realized we were frozen in much of the country.
Is that a pun? We were frozen?
Yeah, that's right.
Get it? Yeah, look at you. That's why he's in the middle right there. Boom, boom.
But the point I'm trying to make is that with that first quarter GDP backing off, you're going to get the pundits talking about, we're headed back for a recession. I don't buy it for 1 second. I think actually we're going into a period of prosperity here. I really do. Don't you?
Both of you think that?
Exactly. And I'll tell
as
you
long
why.
as he thinks that you're happy,
Yeah.
I'm not enough.
Yeah, sometimes you just start tooting the horn.
Two to
and
one,
like,
yeah.
whatever,
But let's talk about what came out today as well.
Yeah.
Was jobless claims down at 300,000. That's a positive. So don't just look at the first quarter and say, things are terrible, going to be terrible going forward. And then also corporate profits. Corporate profits came out at $1.88 trillion in the first quarter. That's up 5.2% over the previous year.
Wow.
So
well, hold on a second though. Let's talk about
happen?
it because
Sure.
first of all, that probably has more of an impact than anything.
Exactly.
Because that's a fundamental issue. It means that people are buying, people are selling, and earnings and revenues are going up. The jobless thing, I don't think anybody really believes those numbers that are coming out of the Bureau of Labor Statistics, because when you can add 250,000 jobs the week of an election, I think we all know. I think we all know that it's a little suspect. However, though, the job thing's very important. The job things are a bigger part, and the earnings thing's very important.
Yes.
Talk about that for a minute, because it is so symptomatic all the way down the chain. If corporations are earning more, it goes all the way down to Johnny Lunchbucket making more money.
Right. And we talked a week or two ago about capital spending and so forth. If you're a business and you got higher corporate profits, you're going to start spending more money to increase your business because you want to make more money.
Right.
So again, during this frozen period when things were bad in the economy, businesses still grew their profits by 5.2% year over year. Not quarter over quarter, but year over year.
So think about that now, which is interesting in and of itself, because at some point, profits were 12% in this country every year. You'd see that in the 60s and the 70s.
Right.
And then an 8% profit margin was reasonable when we hit the 90s. 5% is actually respectable right now.
We're talking about a 5% growth.
I get it.
Not the margin, but
I get it.
growth.
I get it. But the margins now, when you have margins equaling growth, it means that the margin's going to grow next year or the year after.
That's right. Yeah.
So the point I'm trying to make is most companies have been on such slim profit margins. In other words, they bring in $8, they keep in they keep 5% of that. Okay. Wow. What I'm talking about though is now that things are evening out with the growth as well as the margin, you watch what's going to happen in the next couple of years. And I think that's one of the big reasons I think prosperity is on the way here.
Right.
Now, how does that relate to the stock market, Brett?
Well, the stock market, again, you got growing profit margins, you got growing profits and all this. That means more money for the companies. More money for the companies means their profits will go up. Their profits go up. The PE ratio is going to go down, makes the company more of a better buy.
And they can take that money and do whatever they want with it. They can pay down if they have outstanding whatever credit. They can put more into their marketing, get more people to see their product, then hire more people to build that product because more people just saw it. So it kind of, it grows the circle because they've got more money to use.
Yeah, you got more money to expand it and so forth.
That's
so it's a great thing. They can expand overseas.
Right.
And so there's so many things you can do when you make money. You can make more. Exactly.
Okay, let's move over to the Treasury notes and bonds. Why do we care about the Treasury, Brad? Why? Because I think a lot of people think that's old people investing, and I think that's a farce. I think it's something that we all need to be paying paying attention to.
Right. And I would not invest in treasuries right now. It's not the thing to do. But you have to understand what's going on. The treasuries hit like 2.43% the 10-year today, the lowest in almost a year. Oh, my gosh. And what happens, people think about, oh, my gosh, the economy's slowing down. We're going back to a recession because the interest rates are falling on treasuries.
Right.
That is not what's going on. We have to realize we're in a global market. Right now, the developing countries have lower interest rates than we have in the U.S., and we're a much stronger country. UK, Canada, Germany, they have a lower 10-year treasury rate than we do. So we're competing on a global scale, and that's why our rates are falling.
What's the elevator speech on a treasury?
Yeah, well, no, Russ, you explain. You tell us what a treasury is.
I don't know. Someone at the treasury sells their money. I don't know what the hell a treasury is. Who is the treasury? What do they do? What are you talking about?
Brent, let's take this one.
Give me a treasury. What?
I've had to deal with this for 18 years. You take it.
Hey, what's a treasury?
You're loaning the government money for the next 10 years.
Oh, that's...
Let's explain what this is.
That's a shady group. Let's explain.
I think it's the best in the world. But
well, what you're doing is you're buying a piece of the debt, basically, right? Isn't that a better way to put it, or another way to put it? I should say.
Right.
So, in other words, if a bond is nothing more than so let's say a stock, Brent and Sully company. Okay?
Right.
You own a share of stock in us. It means you own a piece of us.
Good company, by the way.
Now, it's a great company.
Yeah.
But in fact, you should
Can I
invest.
pick which piece I own?
In fact, this is an offer. This is a solicitation.
All right. So I own a little piece of your company.
Right. Now, versus Brent and Sully owe a debt. You buy a piece of that debt. You own a share of the bond. Okay. So that's debt versus equity. In other words, when they issue bonds for municipalities, the problem is that banks don't have enough money to loan a city to build a bridge.
Right.
Okay. So they go out there and they consolidate the debt and they let people invest in the debt and then they pay the debt back among several people.
You hope.
The Treasury is the same sort of thing. We're loaning money to the Treasury.
Right.
Is that a safe? Is that safe though?
Sometimes it is. Sometimes it isn't.
We have to say it's safe. I mean, it's backed by the full faith and credit of the United States government. So as long as they're in business, which I think they will be, they'll be fine.
So far, they've never gone out of business.
That's right. They've never gone out of business.
We've got other problems.
The other thing we have to talk about, too, is supply demand on that Treasury. Because what happened in 2013 was the stock market had this nice rally.
Right.
Well, we have like $18 trillion in pension plans. Now, $9.2 trillion is in your managed plans, not your 401ks or IRAs. That $9.2 trillion, what that has to do is that has to rebalance going from stocks as high return. They got to get some into bonds. So therefore, they have to buy bonds. And what does that do? That brings down the yield again. So you got the global competition. You've got these $9 trillion in pension funds buying bonds. It's going to bring the yield down. Yeah. It's not a problem with the economy.
Wow.
Don't even think that.
Hey, let's talk about the economy as a whole. You know, we talk about GDP, 70% of our GDP being consumer spending and a lot of that driven by jobs. I think a lot of it also is driven by that consumer sentiment we talked about the other day, too. Do you think people are feeling safer right now?
They are. There's a consumer sentiment looks very good. I think it's around 80 or so. That's very positive. I think it's like even 82. And again, think about 2009. I think it's like in the 50s. So things are coming in much better than before. Consumers are spending more. They feel more comfortable. I think the second half of 2014, you better buckle your seatbelts because you're going to see some great things coming out. And if you're not invested in some great quality companies, you're going to be saying December 31st, oh my gosh, I missed it.
Well, okay, yeah, and the oh my gosh, I missed it thing is not the speech that we want to be able to say here. Brent, thank you so much, buddy. We got to talk about Apple next time you're here because Apple, $3 billion for the company Beats, and they're not changing the name, by the way.
No,
every other time they've changed the name to Apple product.
Apple Beats.
Apple Beats. Fantastic. Sounds like a restaurant.
Wish you could talk about that. We'll do it next week.
Brent Wilsey, WilseyAssetManagement.com. There's his website. Thank you, Brent. Appreciate that.